The IMF says that global economic growth this year is set to be the worst since the pandemic. Well, the cut in forecast from the IMF means it reckons global growth in 2025 will be just 2.8%. It's firmly pointed at tariffs as the main reason for the downgrade. The country hit with the biggest downward revision, the USA. The IMF expects the world's largest economy to grow by just 1.8%. Well, Lauren Saidel-Baker is an economist at ITR Economics. Lauren, what do you make of the downgrade from the IMF and their reasoning behind it?
I think this is very reasonable. We do expect tariffs, trade tensions that slows the rate of global growth, that decreases global trade. And global trade does tend to encourage more growth in more countries. So I think this is a very reasonable starting point. I am glad that they didn't push the growth rate down so far as to go negative. I still don't think tariffs are enough to push us into recession, certainly not on a global scale, but I don't think even here in the United States.
Well, yes, the IMF did say there was just I think a 40% chance of a recession in the USA. Do you think that's fair?
The chance is increasing. That's very true. We at ITR Economics, we don't give a percentage chance of recession. Really, we are looking at tariffs as limiting activity, really as just creating more complexity across the supply chain. The stated goal is to bring manufacturing back, but even if that were to happen, and there are a lot of reasons that it might not, but it would be a longer term process. So we're looking at this as very detrimental to short-term growth, again, pulling those growth rate down at just the time that we were only starting to see manufacturing growth, industrial sector growth starting to lift off after a pretty sluggish 2024.
Well, now let's look at the Federal Reserve. And there were threats from the president that he would fire its chair, Jerome Powell. Mr. Trump has now rode back from that. But just how damaging would that have been if he'd followed through with that threat?
That certainly could shake up markets. Now, the Federal Reserve, their job is not to protect asset prices, but the stock market, investors in general, they do want to see stability there. It's the Fed's job to protect really that longer term economic view, to balance their dual mandate between full employment and stable pricing. Whereas the president, that more politically minded individual, they're looking for short-term growth. That's not the Fed's job. That's why the Fed is independent. And at the moment, that's why Powell and Trump are really butting heads here. So I think the big concern as we see it today, it's not the policy so much as the uncertainty. That's true with tariffs. We get a tariff announcement, then we see it rolled back or a 90-day pause or what have you. I think the same would be true with the Fed. If we did fire Powell, maybe the replacement isn't even that bad. We do have some very reasonable individuals who are being suggested, right, rumored for that position. But at the end of the day, the law isn't clear if Trump could fire Powell. So going through a court case, having that uncertainty, I think that is really what would be risky to the markets. So Powell's term runs into May 2026. I fully don't expect him to get renominated by Trump, but at least we have that certainty for the next year or so.
So should we be questioning the independence of the Fed going forward?
It's certainly a political touch point, and many individuals, both politically appointed and, again, some who are being suggested that they could be on Trump's shortlist as a replacement for Chair Powell, they are suggesting that the Fed has gotten a little bit more political lately. Now, it's hard for them not to when they have to opine on things like the inflation impact of tariffs that just gets politically, however you look at the data. So I think they are still independent, and I think that independence is crucial to the U.S. economy going forward and to the global economy as we look at it.
But surely this could have some influence on future interest rate decisions. We've got one not too far away.
Absolutely. Clearly, the pressure coming from the president is something that Fed officials are going to have to see through. Again, they are not looking at short-term growth. They are not here to juice asset prices. Their job is to protect full employment and stable pricing. And I do see inflation coming back, not just for tariff-related reasons, but for some very fundamental factors. So Fed officials see that. They're starting to get a little bit more nervous about inflation. We've heard that come out in Fed speak recently, especially with regard to tariffs as being a real upside risk to pricing. So I think this ongoing tension, it's adding some headlines, it's adding a little bit of noise, but I don't think it's changing their fundamental analysis.
So you're not expecting a rate cut next month then?
I would be hard-pressed to say a rate cut is coming. Again, I think inflation is the key factor that's going to hold the Fed back. They want more certainty. They, like everyone right now, want to just wait and see, get a little bit more data. There's too many unknowns out there at the moment.
That was Lauren Saidel-Baker from ITR Economics. Don't forget you can watch more videos on Reuters.com.